Cleveland Cliffs off the lows. Shares are still under pressure despite beating estimates. Jimmy, so it was down 4.5%, right? So it's come back a bit. What's the story here from a stock that you've touted on this program very often?
Yeah, and the results have been very, very good. I have to say to my colleague to the right that in the 4 years I've owned it, it's up 115%.
Good for you, Jim.
The S&P is up 49%
because
she was slamming me 30 seconds ago. But here's
she owns the stock too. What are you talking about?
Well, you heard it, but anyway, let me get to the point here.
I don't know
this is what's going on here. This is what's going on here. And actually, I love Stephanie, and not just because she's in Cliffs, but because she pointed out that Cliffs has raised prices twice in the last 2 months. While their costs are going down, their volumes are going up as cars are being produced, and their CapEx is going down because they did all the work they had to do last year to upgrade the assets that they bought from ArcelorMittal and AK Steel. So you're going right into the sweet spot here, attractively priced, free cash flow. They're paying down debt. They're buying back shares. It's about cash flow.
It's not about orders or deliveries. It's about cash flow.
It's about
you want to give
flow.
Steph a tutorial on how they actually get to the cash flow? Is it the iron ore, then the steel, the molten, then they sell it? And, okay, just making sure.
Cliffs is like in the sweet spot with the infrastructure bills that have been passed, right? And auto, they have a very big exposure there. So those are the two reasons actually I got into this stock late last year. But it is trading at 4.8 times EBITDA, so it's super cheap. And all I care about is adjusted EBITDA and volumes. And they beat on both of those metrics. So the headline was a little misleading. We don't really trade this stock or own this stock on the earnings per se. It's just too volatile given the underlying commodity price. But I do think fundamentals are really shaping up well. Recession
here means what for the stock, which had a 52-week high of 34 bucks? Mr. Bull?
Well, it is virtually impossible to make a bull case in a real recession for a steel company. I mean, that's just not how it works. I'm not going to try to do that. What I will say, just about half of their business is autos. We know that autos are being produced as fast as they can get chips. You look at any dealer lot, and they're like 1/3 of what the inventory should be.
Why is the stock down 41% from the high?
It got a little ahead of itself. Now, listen, to have these sorts of results.
I'm serious.
I'm being serious.
The auto market has been red hot.
Let me answer your question, because this is an important question and it's an important answer. These sorts of returns on a stock like this, I just told you over the 4 years I've had it, more than twice what the S&P 500 has given. In order to get those sorts of returns, you have to put up with volatility. Yes, I know it was at $34 a share a year ago, or maybe it was 10 months ago. I didn't sell it then because I think it will be higher than that. But you have to hold this stock to get the sort of returns that I'm talking about through thick and thin. You can try to trade it. You can try. I haven't had good luck. I have much better results when I just hold this stock.
Okay. Up next, Mike Santoli will be here with his midday word, and still ahead, of course, we're going to grade your trades. We will be right back.